Okay, let's look at a transaction analysis problem. Here it says wages of $867 for the last 3 days of the fiscal period have not been accrued. So what we need to do is go ahead and recognize the expense that's been incurred and create a liability to show that we now owe our employees that money. So the way that we would do that is we would go ahead and debit wages expense and credit our liability account wages payable for $867. Now going back up here to our effect on the basic accounting equation, we know that expenses are going to reduce our net income and liabilities in this case are also going to increase for that $867. Let's do B. Interest on $170 on a bank loan has not been accrued. So this is very similar. We've incurred the expense, but we haven't yet paid it. But we need to make our financial statements as reliable as possible or as accurate as possible. So we want to go ahead and show that we've incurred that expense. So we will debit interest expense and credit interest payable for the $170. Now the other thing here, again, interest expense is going to decrease our net income and our liabilities, interest payable, is going to increase. All right, C, interest on bonds payable has not been accrued for the current month. The company has outstanding $240,000 of 8.5% bonds. So it's the exact same entry that we did here in B, we just have to calculate the amount of interest. So you need to take the amount of the bond, the face value of the bond, $240,000, multiply that times the interest rate, which is 8.5%, and multiply that times 1/12, 1 month out of 12, and that will give us our interest for that particular period, which should be $1,700. Again, debit interest expense, credit interest payable. So our expenses are increasing. Expenses increase with debits, and our liabilities are also increasing. However, the expense actually decreases our net income. So there we go. All right, D here. The discount related to bonds in Part C has not been amortized for the current month. The current month amortization is $50. Well, let's scroll up and look at C. Interest on bonds payable. Okay, so it says the discount. This was what I was looking for. Premium or discount. In this case, it says we have a discount on the bond. So this $50 is going to increase our interest expense over the life of the bond. So every month, we'll have a $50 increase in our interest expense. And then we will credit discount on bonds payable for $50. So that's reducing that contra account for bonds payable. So that will be $50. So because of that, our net income will go down by 50. But our long-term debt should go up by 50 because the value of that bonds payable is going to increase by the $50. Okay, let's look at E. Product warranties were honored during the month. Parts inventory items valued at $830 were sent to customers making claims, and cash refunds of $410 were also made. Okay. So we have to think back to what that journal entry looks like when we have a liability, and we would have debited our warranty expense, estimated warranty expense, when we sold the merchandise and credited estimated warranty liability. So in this case, we need to go ahead and debit our estimated warranty liability, credit the repair parts for the parts that were required to fix the merchandise, and then credit cash because it looks like we refunded $410 to our customers. $830 worth of parts were sent, So if we add those two together, that's going to become my debit to estimated warranty liability, $12.40. So our assets here are going to go down by the $12.40, and my liabilities are going to go down by $12.40. And then we have F. During the fiscal period, advanced payments from customers totaling $1,500 were received and recorded as sales revenues. The items will not be delivered to customers until the next fiscal period. Okay, so in this case, we received that money and recorded it as a revenue when we shouldn't have. Normally we would have, in that case, we would have debited cash and credited sales revenue. And what that's saying is that was inappropriate. We shouldn't have done that. So now we need to debit our revenue to reverse that and take it out of our revenue until we've actually earned it. I'm just looking here, it must be sales. And then we'll credit our unearned revenue. So we're increasing the liability and we're decreasing the revenue by that amount, $1,500. So our liabilities here would have increased by $1,500, and our net income would have decreased by $1,500. Let's just take a quick check, see if we got everything correct. Looks good. Let me jump over to the next problem. There were a couple of those I wanted to touch on real quickly that were a little bit different than the ones that I covered here. First one would be B. Real estate taxes of $2,400 applicable to the current period have not been accrued. So again, we've incurred the taxes, but we haven't yet paid them. So we need to go ahead and show that we've incurred those through an expense, real estate expense, taxes expense, and then show the liability that now we have to pay those taxes. That's just happened through the passage of time. So $2,400 was that. So we would go ahead again and decrease our income, $2,400, and our liabilities here are going to increase by $2,400. The next one I wanted to look at was D. The premium related to the bonds in Part C has not been amortized for the current month. The current month's amortization is $70. Well, we did a bond discount a second ago. Let's look at a premium. So premium actually reduces the amount of interest expense. So we credit our interest expense in this case, and we debit premium on bonds payable for $70 to reduce the amount of the premium. Oops. So in this case now our net income is going to go up by $70 and our long-term debt will go down. Okay, let's see. How about E? Let's look at E. It says, based on past experience with its warranty program, it's estimated that warranty expense for the current period should be 2% of sales, $918,000. Well, a second ago we showed the entry when we actually did the repair parts. Now let's look at when we would actually create the warranty expense. So we multiply the $918,000 times 0.2%. And when we do that, we get $1,836. We debit the expense, estimated warranty expense, in the same period when we make the sale, and we credit estimated warranty liability then. So our net income is going to decrease by $1,836, and our liabilities now will increase by $1,836. Let's see if there's any more. Yeah, let's do the F. That looks a little tricky. Analysis of the company's income taxes indicates that taxes currently payable are $76,000 and that a deferred tax liability should be increased by $21,000. Woo! Okay, so our income tax expense in this case is going to be the sum of those two added together, which is $97,000. Then we are going to credit our income taxes payable, increasing our liabilities here, $76,000. and also increasing our deferred income taxes payable, $21,000. Okay, so now here's the impact then. So on our net income, it's going to go down by $97,000. Our current income taxes payable, which is a current liability, is $76,000. So our current liabilities increased by $76,000. That deferred income taxes payable is just monies that we're going to have to pay eventually. We just don't have to pay it right away. So that becomes $21,000 of long-term debt. We can check my work. I didn't do A and C here, so those might come up incorrect, but everything else looks good. Thank you.